All right, we're at the top of the hour. I want to thank everyone for joining. My name is Anthony Butler. I am the Individual Disability and Critical Illness Specialist here at Art Jetter & Company, and I want to thank you for joining part one of our three-part webinar series. What we're going to be talking about is some DI protection sales strategies, and part one is going to be about how to present a no-loss insurance strategy, and I have on the line Brock Falconer, who is the Regional Disability Income Sales Manager with Illinois Mutual, and he will just kind of go over some quick hit ideas for you guys. So with that, Brock, you want to take it away?
Absolutely, Anthony. I appreciate it. And can you hear me okay?
Yep.
Fantastic. Really appreciate you guys' time today. We'll get it in to it real quick here. And again, we want to make quick and easy, quick hitter strategies for you guys in this three-part series to essentially take out to the streets immediately. We want you guys to really have some strategies to really help promote DI sales and ultimately make it as easy as humanly possible to be holistic in working with folks and making sure that income protection and disability insurance is part of your risk protection and overall strategy in working with clients. So we're going to talk about weighing the loss, ultimately a new way to look at individual disability insurance in the concept of creating a no-loss disability insurance sale. So one thing we need to keep in mind is the simple fact that the odds of becoming disabled are essentially 1 out of 4. Now, we're not saying the odds of being permanently disabled by any way, shape, or form, but we're saying that 1 out of 4 individuals during their working career will suffer a disabling event of at least 90 days. The majority of disability claims are not long-term. It's a very small percentage of claims. But again, that doesn't undermine the importance of income protection or disability insurance in any way, shape, or form, because the simple fact is the majority of people in society that we work with as clients, as peers, family members, even ourselves, would be at a detriment if we did not have any fallback payroll or money available to us should we suffer a disabling event. We think about kind of a simple and easy way to explain DI. A concept that's often utilized is the idea of job A, job B. Really the simple concept here is that if looking for jobs, you have 2 opportunities and you're looking to pull the trigger on one of the 2. Job A would pay you 100% of the income that you would need and what you're looking for to essentially fulfill your career and to really shoot after kind of a career choice. However, sick, ill, injured, again, unable to collect a paycheck because unable to work, you'd receive $0. Job B would pay you 99% of the income that you would be looking for to, again, drive your family, have revenue to pay for your bills, personal expenses, and live the life that you're used to. However, sick, ill, or injured, you'd receive a tax-free check to make sure, bare minimum, that you have tax-free dollars to pay for your mortgage, utilities, and your groceries. Job B is Job A, however, with taking the responsibility of purchasing an individual disability insurance plan. There's really no difference, again, between the actual jobs and really the actual pay. Job B is just taking Job A, but in turn, working with Art Jetter and other professionals in the industry to make sure that you've taken responsibility to purchase an income protection plan, the bare minimum cover your mug insurance, because we know 1 out of 4 individuals would essentially trigger that policy, need Job B in lieu of Job A so that they have a tax-free check to cover those minimalist expenses in their life to make sure the roof stays over their head, lights stay on, and food's on the table. If we think about turning the tide a little bit, we think about a very, very easy, simple concept of premium reimbursement with a disability insurance plan, a term that I've coined very sillily, baby math. Round numbers here that can be changed and adjusted according to any client you would ever work with. The round construct that I utilize with a client's income at $50,000, right? The max benefit amount available to that client as an income protection plan is 60%. Keep in mind quickly though, 60% seems like a low percentage, but that is a tax-free dollar amount. So if you think about the client grossing $50,000, we know they're not taking home $50,000. There's some tax liability there. Therefore, 60% tax-free coverage is probably truly closer to 80 to 90% of their take-home pay. So as we concede that, we know the max benefit amount available for income protection, paycheck insurance, disability insurance. However we want to slice it, dice it, put it in a box, and whatever bow we want to wrap that box in, the max benefit's $2,500 tax-free. Premium in our market, Illinois Mutual, where we really find the premium tolerance, again, is about 1% of a client's income. In this case, we know that would equate to $500 annually. Very easy, simple baby math. We think about that client over a 10-year span of time would have paid in $5,000 into this policy, right? However, if they're disabled after 10 years of paying in $5,000, they would reimburse every penny that they put into that policy after only 2 months of suffering a disabling event and therefore collecting 2 months worth of claim payout, right? $2,500 a month tax-free for 2 months, $5,000 tax-free. Again, we're talking about tax-free dollars to pay for the mortgage, utility, groceries, in lieu of wiping out savings, retirement, assets. We can go on and on. Again, very simple and easy way to talk about how even after a 10-year expansive time of putting this money into the policy, it would only take a couple of months. If you're that 1 out of 4 individual that triggers a policy, we know the odds. A couple of months, you'd have reimbursed every penny that you put into the policy. If we change the numbers a little bit and say the premium over 5 years would have been $2,500, we therefore, again, using our very rudimentary math skills that we're utilizing now, would take 1 month of being on claim to reimburse everything you put into the policy after 5 years. So again, very simple and easy way to show the tangibility and the perceived over actual value of an income protection plan. We know the job A, job B. This flips it on its head, is a premium reimbursement concept. And again, we know the odds. 1 out of 4 individuals found themselves purchasing the best possible thing they could have. Let's throw another wrench in here. Illinois Mutual being a carrier that specifically has a very solid niche rider that's on almost half of the policies that we sell. That is return of premium. The idea being, let's set up a savings account that will pay you all of your money back if you do not trigger a disability policy. All of your money back at age 67. As we see on this slide, as of the end of 2016, Illinois Mutual has returned $115 million in premiums to policyholders, again, with this return of premium rider. We'll concede very quickly and easily that it's a fantastic opportunity for us as a carrier because we're going to obviously take these premiums with the added cost, of course, for that return of premium rider and invest the dollars on the side. It helps with persistency with our policy owners as they keep it in force since they put extra money in to have this rider on their policy. And therefore, again, we invest off of the premium dollars. The client is investing in their income protection and being responsible, therefore, in lieu of that. And on top of that, again, policy if you need it. We know the premium reimbursement scenario, 100% money back if you don't. Well, let's implement this as far as how a policy would be structured with it. Here's an excerpt from an illustration. We utilize valued client. If anyone knows the 40-year-old valued client we're talking about here, please don't tell them. Again, policy with and without return of premium is illustrated here. This is a part of every illustration that you include return of premium in as well, keep in mind. Again, few things to point out here. Number one, we see the cost with and without the rider, right? And obviously the rider in this case adds about 75% or so on top of the premium. But why is it doing that? Because it's saying at age 67, if you purchase a policy without the rider, yes, you would have only paid in $27,000 and change, but again, you would receive $0 back at age 67. In lieu of that, let's look at putting extra premium in for this rider. Again, in this specific scenario, it added about 75% onto the cost. However, at age 67, the difference is you're going to get a 5.77 equivalent annual rate of return on the investment of extra money into that rider, because you're going to get back $47,000 and change at age 67. Again, this is the scenario that would evolve whether you purchase the rider or don't purchase the rider if you never go on claim. If someone went on claim, the return of premium payback would be lessened by however much premium dollars are paid to the client. However, we also need to keep in mind that there's a waiver of premium on the policy. Therefore, when you're on claim and collecting benefits, you're not paying dollars into the policy for premium anymore. So obviously, this whole construct would be adjusted a little bit. But again, we talked about 1 out of 4 people trigger a policy. Therefore, this is the best thing they ever could have purchased. would reimburse everything they put into it over a very short period of actually being on claim. However, 3 out of 4 people, which we know everyone's going to connotate themselves to the 75 percentile, can't afford it, will never happen to me, being the 2 biggest excuses, fantastic. I have a fantastic ability to give you a huge rate of return on essentially what is a savings plan with an insurance policy attached. Policy there if you need it, all your money back if you don't. And we know the if you need it portion is going to essentially be all of your money back as well. That's where the no loss concept of what we're talking about today comes to play. Let's go further. Let's go back into our baby math scenario. Same client, 50K income, max benefit $2,500 a month. Nothing's adjusted here. However, when we add in the return of premium, we know there's going to be an uptick in charge. Here's the deal. Let's go ahead and double the premium for, again, this foundational approach to the perceived versus the actual value of an income protection plan. Let's double the premium. We'll call it 2% of income now. We know because we are math wizards, we've already established that. That's $1,000 annually now in cost, right? We've doubled it. Premium over 10 years now is $10,000. Well, all that did was change our reimbursement scenario if this same client actually goes on claim after 10 years, and now it takes 4 months of receiving benefit to reimburse again every penny they put into the policy, even every penny with the added cost of return of premium. We also know that very seldomly is the return of premium writer going to double the cost. So we are over-assuming and even better in our delivery because we're going to actually show them when illustrated a lesser cost of the overall policy because the return of premium is very rarely going to double the price. But again, taking this approach, under-promising, over-delivering, this again creates a reimbursement concept even with the added cost of this rider, to whereas this is a fantastic actual value versus perceived. Again, 1 out of 4 people, this would fit, as well as obviously the premium reimbursement without the return of premium. But again, the difference being 1 out of 4 people, all of your money back even after a short amount of time of being on claim. 3 out of 4 people, all of your money back at age 67. Where, again, is the loss in taking responsibility for your income protection? Again, this is in lieu of wiping out savings, which if we think about the odds of being on claim is probably right around, us at least as a carrier, about 1 year of average claim. The industry is about 2 to 3 years of average claim. We trigger a lot of claims quicker than other carriers. That's the reason for that. But again, we think about savings is going to be wiped out typically within the first year. If we think about people putting aside 10% of their paycheck for savings, again, about 10 years worth of savings is going to be knocked out in the first year. Now we're looking at retirement. Not only do we have access to those funds that are no longer going to be available for retirement, but we also know the large penalty for doing so. Assets are going to have to be short sold. We can really unfold the what if. Asking a client, do you have a plan in place for income protection, for mug insurance, for paycheck insurance, for disability insurance? Again, all the same, different boxes, different bows, exact same actual thing. Do you have a plan in place? The answer will oftentimes be no, but that's incorrect. There's always a plan in place. Without an income protection plan, your plan is self-insuring or your plan is rolling the dice and hoping. We can show them with this concept that there's a no-loss opportunity other than premium sacrifice now that's going to be reimbursed one way or another. And with our no-loss concept, I think we could really move the dial on making sure more folks are taking advantage of this opportunity. And again, not going with their current plan, which essentially is having to self-insure and figure it out when it happens. We know how detrimental that's going to be when it unfolds. A scenario that can often be utilized, as we do in all kinds of sales capacities, is the good, better, best. Let's keep in mind that we have an ability, and you obviously partnering with ArtJetter have the ability to really set this up in any way, shape, and form that you would like to. The main idea being, let's start with a minimum contingency idea. Let's start with the bare minimum. Let's make sure we start by making sure the mortgage, utility, and groceries is covered. We can always get to the finish line. We could always give them a little bit more stew because we're cooking up a big pot and back, but let's bare minimum make sure they have a no-loss policy and a minimum contingency plan in place, because you don't get a vote on whether you can show up to work tomorrow. You don't get a vote on whether you're in the 75 percentile of people that don't suffer a disabling event versus the 1 out of 4 that do. Let's set up a scenario to whereas there's really truly no ultimate conceptual loss in purchasing a plan, because it's there if you need it, all your money back if you don't. Really appreciate you guys' time today. And again, this is a 1 out of 3 quick hitter, take the idea to the streets marketing campaign that we really want to make sure that you guys feel more comfortable and have ease of use of disability insurance, as well as the fantastic services of Art Jetter and Company in pursuit of income protection, and obviously all of you other client needs. And I really appreciate you guys' time today.
Brock, thanks a lot. Really appreciate it. Guys, if you have any questions or you need any proposals run, please feel free to give me a call. Again, my number is 800-228-0008. My extension is 1032. I want to thank everyone for joining, and we'll talk again next week. Thanks.